Good morning, traders. Good morning, Stelios.
Good morning. Hello,
Hey, how are we
everybody.
doing?
Good. How are you?
Yeah, good. So Ryan is off today. Stella and I will be your hosts for today's show. I hope you don't mind. Brian already telling us that he misses Ryan. Send him a Christmas card, Brian. Send him a Christmas card. You will be happy about it. Okie dokie. So let's not a lot is going on, so we are going to keep the headlines relatively short.
Yeah, it's amazing. It's amazing. Ryan always finds out. He says, "Oh, this guy said this guy said that." I don't know how he keeps up with all these, central bankers and stuff, but he does a great job. It's difficult to fill his shoes. I must say.
Yeah, he does a really great job. Mind you, I did take 2 pages of notes.
Oh wow.
No, but I mean, most of them are just a couple of blocks, really. What's going on? So we've got more reopening or reducing of rules in China. The latest ones were Shanghai removing tests for restaurants and entertainment, but they're keeping it for schools and medical institutions. And then afterwards, we heard from Macau gradually relaxing the rules for mainland tourists. They have to spend their money in the casinos over there over the year-end period. So that's a bit logic that they reopen, I guess. And then Hong Kong is also shyly reducing the rules. They cut the quarantine rule to 5 days from 7, like if I recall well, mainland China was doing as well. But they did keep the social distancing rule. So those for the little details. CNH is not moving much on the back of it. It's in a bit of a range. But the main thing to note, and we'll show that on the charts, is that 7, the big figure, is still capping the events. There was another President Xi is visiting Saudi Arabia with a whole host of entrepreneurs and other officials, and it seems the deals are flowing. Seen an article talking about 34 deals already being signed between Saudi Arabia and China, but nobody knows how much they're really worth. So let's wait for a few details on those ones. But we know that China needs some outside help right now before their economy is fully up and running again. And Saudi Arabia, being so magnanimous as they are always ready to help, to lend a helping hand to countries in need, of course. Then over to another Japan. We've already heard that Japan's companies were selling large foreign bonds, but now in November they exited record amount of foreign bonds as the hedging costs were going higher and higher, and they took advantage of the rising bond market to sell a lot of bonds. But in the meantime, we've seen that the bond market has gone a little bit further. Also, I'm thinking it's it's a bit of a double-edged sword, because you can exit your foreign bond holdings, but if from here and because they think also that the yen could strengthen in 2023. But that's the other side of the sword. If the yen doesn't really strengthen anymore, they are going to, if they want to replenish their foreign bond holdings, they are going to pay up higher prices again to get back in. So I'm not too sure whether it's it had its impact when they were doing it, because we saw the dollar yen come off a lot after the Bank of Japan intervened and the MOF, and the bond market rallied. But once it's done, you're there, and then you're left with your quota of investments that you still need to respect. And I'm not sure whether the effect on the yen is now over and we will see a different market unfold, or whether this is still going to continue. That's something to decide later. And I don't know what you think about it, Stelios, if I'm right in saying that this is really a double-edged sword, what they are doing.
Yeah, no, I agree 100%. I don't have anything else to add. No.
Okay. Furthermore, just a couple of articles and polls. The Reuters Polish is showing expectations for the Bank of England in the UK next week to rise by 50 BPs. Another RICS data saying that the house prices fell by more, and the activity in the housing market in the UK fell back to 2020 levels. So
biggest monthly drop in years, from what I read. So this is not looking good.
Yeah, absolutely. And when we're talking about the US housing market, we have to know that it's the same everywhere, right? It's really the same everywhere. And another one saying that I think that was in the FT or so, that the UK firms are seeing energy costs double next year once the government subsidies are drying up. So things are not all looking rosy in the UK, but again, it's the same thing everywhere, because the EU also, the different countries in the EU also implemented those subsidies. So that is something to watch later. But when we talk about macro events, we have to put that in a little drawer and know that those things are going on a bit everywhere. Then just another couple of lines. Germany's Scholz, he says he doesn't expect US inflation act to massively impact EU competitiveness. Germany is seemingly a bit distancing itself from global EU comments lately. We've seen it on the energy as well, that they were trying to inject a lot more than what other countries were planning to do. And we've heard from the EU that they are really making a lot of noise versus this US Inflation Act. And now Scholz is saying he does not expect a big impact on the EU competitiveness. And lastly, that is really a sector, because everybody, of course, is impacted by this high inflation. And there's an interesting line just on the side by the Airbus CEO saying that they can cope, and the sector, the industry, can cope with 2 years of high and spiky inflation that can be absorbed. But if it will last for 3 to 5 years, then it's going to get very, very difficult. We've seen that in other areas as well. So the hope is now, and we are expecting inflation to come back in 2023. But if it would last beyond 2023, something to put in the back of our mind, then we may be talking about much bigger pain to take in the global economies than what we are seeing now.
So they'll have to pass that on to the consumer, I guess.
Yeah, for one, yeah, and if you talk about stuff like Airbus, this sector impacts a very big part of the economy and firms. I don't know how many thousands of companies are impacted by the aviation and the construction sector. It's absolutely monstrous, right?
Yeah. No, and then within an economy which is struggling and with disposable income dropping, you increase the price of goods and services. There's only one way for things to go, and that's down. So this is not. This is definitely not good. But anyway, yeah. I mean, one thing I noted worth mentioning is that in the UK, I read that they approved the opening of the first deep coal mine in over 30 years. So this energy problem is bringing back solutions which were long forgotten. And you look at the environmentalists, I'm sure they're foaming now when they see things like that, which is we're going back instead of going forward. But I guess that's what desperate times need desperate measures. And what I personally don't get is that environmentalists have always been really against the nuclear power. Which is now, with the technology increasing and getting better and better, it's probably becoming one of the cleanest forms of energy and most efficient, that's for sure. And they're resisting the extension of nuclear power, but we open more deep coal mines. Yeah, there's no problem with that. I mean, I don't get that, but anyway, it is what it is.
Yeah, but they did already say that they were worried about it for the possible earthquakes and stuff, right? So
yeah.
But
Okay.
I know. I mean, this. I fully agree with you. It's cleaner and more efficient to reopen nuclear reactors than starting to dig for more coal, right?
Yeah, well, you've seen countries like China and I think India as well. Anyway, big countries who are making huge investment in that. China are planning to open dozens of new reactors, and so are other countries. But you have countries like Germany who hate them, and the Scandinavians and all that. But it is what it is. But I think it's going to be a big part of energy going forward, whether we like it or not.
Speaking about this nuclear energy, we know that some months back, Japan allowed for some of their reactors to restart. And
restart, yes.
I think 2023 is going to be quite a year for those nuclear reactors over there, because with the new rules, after Fukushima, they of course obviously tightened the security rules a lot. And quite a few of their reactors over there are getting old. But I think 2023 is a year to pay attention to how Japan will be able to handle its energy imports. And we know that Japan is mainly an importer of energy for the past 10, 12 years. And that is one for the agendas as well, to keep an eye on going forward in 2023.
Yes.
Lastly, more and more US banks are starting to warn their customers about the coming recession. Oops, let me kill my squawk just for a minute. So the latest ones were JP and BOA. They think the consumer is still pretty okay right now, but they're starting to send out warnings for 2023. So they are preparing the terrain as well, that it's possible that the US is going facing more pain in 2023. So that was the last little article I read overnight, and after that we can perhaps move at to what's happened on the data front. And really, what should have been the bigger mover yesterday was the Bank of Canada statement. So they did go for a 50 BPs, but then they took out a few lines, changed a few other lines. So they're not outright hawkish anymore, because they took out a line saying that it definitely needs further rate hikes. Now they are going, similar to other central banks, to a more data-dependent plan. Also saying that the rate hikes are starting to weigh on the local demand. So they want to see the effects of that, but in the meantime, they still added 50 BPs to it. And they were saying that the jobs market is still holding up well. Take the FOMC statements, make a copy paste, put your country on top of the paper, and send out the same messages. It seems that the central banks are all again aligning themselves. which we have seen in various degrees in time, but which we have seen really since the pandemic. They're all very much aligned right now. So as a result, we'll have a look at the prices, but as a result, Canadian dollar strengthened somewhat on the 50 BPs announcement, but then basically versus dollar just came back to where we were pre-announcement. So we had a retest of the 136.90 figure overnight, and again this morning, but we're back at 136.5. So that for the Bank of Canada. Oh, since there wasn't any press, sir, I'm just going to run forward just a little bit. We'll hear from Bank of Canada Deputy Governor Korzybski a bit later today. So that's the usual state of play. When there is no press conference, we hear from a Bank of Canada official the next day. So keep an eye on what's going on. That's 17:45 GMT. For the rest, and we'll come to oil as well, but it's kind of interesting that we're seeing a lot of draws of credit. We're seeing, how shall I say, rebalances between gasoline inventories, but then crude inventories seeing big draws over the past weeks. Yet oil is coming off at a quite alarming rate now, must be said. Moving over to Japan, current account, it's only a very small amount, but worth noting that it's come back into a negative territory after a few better months. With the head back above water, but October showed a negative current account again. So keep an eye on that one. If it dives deeper into negative, it's usually not great for a currency. They finally stopped selling bonds last week, and they bought a few. It's not a huge amount, this one, but the selling has stopped at least for now. Slightly better GDP revisions, the capex holding up, consumption still as it is in Japan, very low numbers there. It's a global theme in Japan that the consumer, barring blips here and there, is not really the greatest of consumers in the world. So then over to what we said already, the RICS house price balance dropped very sharply this morning, so we covered that already. Trade balance in Aussie lands moving on. It's hovering around the same levels as we've seen for a while. The economic watchers in Japan, it's diving a little bit more. I guess that's keeping somewhere the yen from strengthening much more despite lower yields in the US. And for the rest, that's about it for what the data are concerned. Next, today, very light. We'll have the jobless claims. Those jobless claims, they haven't had a big impact of late. They didn't see too many moves, but we have to see this number really get away from those 200K zone. If you start to go back above 300K, that's going to be alarming. Or if you drop much further, which is a bit difficult right now, in my opinion. But if it drops much further, it should underpin the dollar. But as long as we are in this zone that is really been seen for months now, I don't think they will have a big impact. So later today, President Lagarde is speaking, and I haven't looked it up more specifically. I don't know. What is she speaking to? Attends the pre-opening of an exhibition at a museum. Oh, I don't know whether we are going to hear a lot about a lot about monetary policy over there. But anyway, keep an ear out for President Lagarde at 18 GMT. And that's about it for the rest of the day. So globally, I think we are now entering the period where we are preparing year-end on the one side. Usually come December, there's hedging going on. Companies, banks, asset managers, money managers of all kinds need to close their books, need to hedge their positions, need to take some pain or show better results where they can. So there can be a lot of hedging going on for that. And the other thing is that now we are waiting for the next set of US inflation data. So the first one will be tomorrow, and then we also have the Michigan tomorrow. So being on a Friday, those could move things around a little bit. And then we are waiting for the next week's PPI just coming out just, I think, the day before the Fed. I think the day before the Fed, and
I think it's Monday, but anyway, it's
Monday,
just before,
yeah. Okay. And then we'll have this whole central bank block, FOMC, ECB, Bank of England, SNB, Norges Bank, Banxico, etc., all happening on the 14th and the 15th. So that's what the market is preparing now for. So I would say that we won't break new ranges, but in the meantime, for the shorter term noise, watch the clocks a little bit, because when there's not a lot going on, when the market is waiting for events, fixings could have a bit more impact if there is some of this hedging year-end stuff already starting to go through. Now, Mr. Stelios, do you want to pick the screen first?
Yes.
Or shall I just do a rundown and then you take it from there, or do you want
whatever you prefer? I'll leave it to you, whatever you prefer.
Okay, let me look at the short-term noise, and then and then I'll pass it on to you. I'm going to keep it short, so
that's cool.
You have all the time in the world to show your stuff, and then we talk about some interesting things. Okay. New share. Here we go. Right. Do you see oil?
Yes.
We've spoken about that yesterday here, I think, or was it on Face or in the chat room? I don't recall. We're in dangerous waters here, and the 72.90, 73 bucks is really getting tested here. It's looking fragile, and I must say, I don't really understand unless it's that ships, those ships being blocked in Turkey or by Turkey, unless that's the reason. I don't see too much of a reason why oil is now coming deeper and deeper. Do you see any reason for this right here and now still?
No, we've talked about it. I don't understand it. And speaking to friends who I've told you, right? I have some ship owner friends, and they tell me that the market's still pretty tight. And if you listen to what people like Tracy Schuchart, who specializes in energy, she says the same thing. So it doesn't make too much sense. Of course, the global picture is deteriorating. So demand theoretically is dropping, but then again, you have China potentially, starting to, I don't want to say open up, but looking more positive. So I don't get it. I don't know is the answer. Like Lucas says all the time, just say I don't know, and I don't know.
Or the other thing is more sellers than buyers.
Yeah, that is true.
That's a very good reason. All right, then. We have to look at yields a little bit this time, because whether it's year-end already kicking in, or the market really worried about what's going to happen in 2023, but those 10-year yields are also looking quite fragile. They're really starting to trade what might happen in 2023. There's a bit of I would call it a bit of an alarm zone if we start to get below those 340s, you see 339, 337, 338. It's looking a bit fragile still. We already need to get back above 350 to stabilize. For the time being, it's still looking a bit fragile in my opinion. Out of your experience, Dale, is there do you see any seasonality or special year-end flows in the money market, in the bond market? I know there is, but could this be the explanation of what's going on right here and now, and we see more of this into year-end?
For the 10-year, I don't think so. I mean, there is seasonality for short-term rates with year-end. I used to trade those all the time, and the year-end turn that
the turn,
that is called, that used to vary massively. And I remember 2008, it was the year-end turn was worth probably 100 times what it used to be worth before. But or maybe I exaggerate, but many orders of magnitude more. But for the 10-year, I don't personally know any seasonality. Going into
so for
year-end.
for the turn, so our viewers have the intel. So for the turn, you're going to look at the short term, and it's actually not even the 2 years. We're talking about 3 months, 6 months.
Yeah, you're talking about very, very short term, because the turn is a 3-day run, right? Which usually has a premium because banks and corporations, banks specifically, they like to massage their balance sheets and show their year-end position to be better than it should be, let's say. So they all want to take in money over the year end. So that 3-day run usually has a big premium. I mean, when I say big, it used to be a few basis points, but obviously in the crisis when you lend somebody money, you didn't know if you're going to get it back. That blew out massively. But that's in a very, very short term. And not even 2 year. You're not going to see it on the 2 year.
It's going to be like in the 3 months and stuff, no?
Yeah, that there you're going to start seeing it. Yes.
Yeah. Because I recall huge moves and don't underestimate FX flows that could derive from that. If non-US money managers need to hedge their year-end dollar.
Yes.
Dollar books, right? They can create really big flows in there. So keep that in mind for those who like to watch seasonalities. Have a quick look on what's happening in the short term yields, and keep an eye on keep them on your radar. Right, I'm not going to spend too much time because the majors are really in ranges. But we've seen in the cable, interestingly, over the past few days, and I'm going to put it even shorter term, this 122, 2540 level is capping the events, and on the underside we have this little trend line coming in here in the low 121s, which really create a nice range to play in. So for as long as we are in that range, I would respect it. In the middle, you have this 121.60, 50, which already showed some interest as well. And the reason for that is that we are turning around this 200 DMA here as well, which today comes in at 121.22, 23. So keep an eye on what's happening in the cable if ever we get down to those kind of levels. And let me just take 1 second of your time because I need to do some hedging, as people say, because I bought some euro sterling again, and it looks that the hourly fixings today have a bit of impact in the euro sterling as well. In the meantime, I'll show this euro sterling. We were really doing ping pong. This line is now getting watered down a little bit, but we're really trading between 86.5 and 86 the figure even. Yeah, this lower end really definitely still sees buyers. So we're trading in about a big figure. There we go. Just done my euro sterling. Yeah, we're trading inside about a big figure for now. As I said, I mean, hourly fixings can have something to say there, but to really start pushing, I think, as people know, I'm long from down here, and I've been trading it around, re-adding. I've re-added last night because I thought there was a risk of coming down here, but it's holding pretty well right now. I'm gonna take this one away. Yeah, so keep an eye on what's happening around the 86.50, 86.70. If ever we get a push into there in any of those fixings. Dollar yen is in a bit of a short-term channel. Could be a bear flag, as people would say, but for that it should not go above those levels, right? But we're in a little bit of a smaller uptrend channel here, upward channel, I should say. First support yesterday, the support held. Support roughly held overnight, so keep an eye on that one. Around 136.60 today, top side 137.40-ish, and then yesterday's levels here are relatively important, I think, for the short term. If it goes back above 138, I think we can push through for another 3/4 of a big figure or so. On the side, if it would go back below 136.60, 136.25, seeing some demand there. So keep an eye on that one. As I said, I think we are in relative ranges. So if you want to trade it short term, this is one to do. Probably keeping an eye on the euro yen as well, into the ECB. Depending on the expectations, we could see a bit of activity in here as well. It's holding the underside of the 143, kept the 50% of the move that we have seen lower from October into November and over November yesterday. So 144.55.60 and 143.10.15 is your initial range here to watch. What else? Oh yeah, the famous one. The ForexAnalytix team effort, I will call it, because we're all looking at this zone here, and a good few of us have been starting to trade this Aussie Kiwi now, myself included. It's the first big test here of the 135 or 105.35.60. Has held, which is pretty good. I'm using this trend line plus this prior low as a bit of my buffer or protection, if you want. But again, I think we need to break back above 106.50.60 to really get going. In the meantime, I'd say observe this little perhaps range which we could trade in inside now. And I guess we are going to need more positive news on China also to get this going. But anyway, looking at this, my impression is that we have done the majority of this move now. You can trade RBA, RBNZ divergence, but into eternity is not something I've seen really on stuff like the Aussie Kiwi. Let's see how this develops, but I think it's a good enough support around here. Anything else? Yeah, quick look at dollar China. It's stabilizing, as I said. It is kind of holding the 696, but really the bigger levels, as we've been saying, are going to be 690 now. And the top end, we're seeing this head and shoulder is 701.5, stretchy to 702.5. As long as this holds, there's probably more room for to come off. If we get back above 702s, I would be very careful, because this correction, I would call it, maybe over, and we go back back higher. Aussie Cat, Charlie, RBA made hawkish hike this week. BOC a dovish hike yesterday. Good balance of trade for Aussie this morning. China opening bullish on this pair. I don't know if I can agree with you, Charlie, on the hawkish hike that RBA made. They only went for 25 BPs. Yes, they said they are still watching, but they are clearly on a kind of slower path than some of their peers. But I won't disagree with you on the pair, because for as long as oil is under pressure, and with China shyly trying to reopen, I could imagine that a pair like Aussie Cat could be worth having a close look at. Katie, Euromex, yeah, that's an interesting one. As people know, I resold it in our chat room. I resold it here, but I'm kind of neutral right here between 2090 and 2040 on the white. We also have the 200 DMA coming in here at 2077. I'm neutral right here. I sold it, and then yesterday, seeing on the prior days the bids that come in already around this 2060 zone, those lows. I'm actually out of it right now, and just waiting for a direction on this one, Catherine. Yeah, really neutral for now. This thing could be really on the move after ECB and Banxico next week, right? We have them the same day, so I think we should keep energy in this pair for when we know the decision about those two central banks, and that's really the last pair I'm looking at today, and I'm passing it over to.
Thank you, sir.
Stelios.
Okay, so first, a little warning. My internet has been quite unstable the last couple of days. So if you hear me stop talking, and if you stop hearing this nice squeaky voice that I have for like 10 seconds, I'm going to take a minute or two to go to switch to my phone's internet. So anyway, having said that, you know me, I like to look at the big picture. And you know, the markets go in cycles, and it's good to understand which part of the cycle we're at. I'm actually writing a blog post about this today, and I'm gonna publish it later today. So we have seen this year, because we have had big inflation. You know, the Ukraine war kicked it off, but I think it was already happening because we got, you know, from COVID, we got helicopter money effectively in the US. You know, people got more money to spend, and it started picking up, and then Russia kind of blew it off completely, and we're seeing double-digit inflation in many countries. So we've had some pretty fast and pretty substantial tightening by many central banks. The Fed is always leading, and in a way, it's good that we have the Fed coming in first next week, and then the other central banks following, because everybody's watching. And the Fed is now tightened. Well, with next week's 50, they're going to have tightened over 4%. And this is in about 9 months. So this is a pretty, or 10 months, whatever it is, pretty fast tightening cycle, and they had to, with inflation going as it has been. So where are we? So the Fed is expected to hike 50. I think that's beyond any doubt. 25 or 75 would be a huge surprise. And so they hike 50, and I've actually made a chart here. Here we go. So where we have Fed fund futures, which are instruments that trade, and they show what the market's expecting for the Fed fund effective rate going forward. So after the 50 that we're going to get next week, we're pricing another 50 basis points, more or less, and that's it. And more importantly, though, we are pricing a couple of months of flat rates, and then we start going lower, and we're roughly 50 basis points below. So 50 basis points of cuts by January 24. Now, this for me has risks. It could well turn out to be the case that this is what they do, but I think the market is going to price otherwise before this gets executed. And what do I mean? I think that it's, excuse me, I think it's dangerous to think that the Fed is going to stop at another 50 basis points above next week's hike. They might do, of course. They might hike and indicate that the hike 50 and then say, we're going to probably be, dropping the pace. So maybe 25 is going forward. It's just, it seems to me to be too little at this point in time with inflation where it is. So I think the risk is that the market's going to reprice higher, a higher peak in rates before it prices lower. And I think next week is a danger for Powell to give us more hawkish rhetoric than the market expects. And also the other thing, sorry, were you going to say something?
No, I'll let you finish on the yields, and then I'll comment on what you just said.
Yes, and then I think the other thing which the market's probably gonna take its time in pricing is the drop, the cuts basically coming in. I don't think it's going to take a couple of months for them to switch and start cutting. So all that being considered, we're seeing 10-year yields reach this support area here, right? It's the Cayman had this on his chart as well. It's also the 50% fib retracement from the August lows to these highs here, so the November-October highs. So I think it's a danger that that there's a good chance that the hike next week is going to be more hawkish than the markets expect. And that's why I think we might see the risk is for us to see one final push higher in yields in the dollar and lower in risk. So I don't know what you were gonna add, Cayman, and then I'm gonna continue with some other thoughts on other stuff.
I mean on those yields, I fully agree with you on and I've already been saying that a couple of times as well. It might be that the 50 more on your line chart there, where with the market expectations, I kind of could agree with that 50 more. It may come in the form of 225s. That's possible. Once they've done 50 next week or so, it could be higher. But where I really don't agree with the market is those cuts in 2023. I don't agree. I really don't agree with it, especially if okay. Let me put one risk point to that. If the job market collapses next year, then yeah, I mean those expectations could become a reality, but therefore it should really get worse than what we are expecting right now. I do think they can stay high for longer until they really have the inflation sort of under control is perhaps a big word, but yeah, there is going. I agree with you. There is going to be some repricing to be done by this market if everything stays like it is right now. I really don't agree with those cuts in 2023.
Well, at least I think the probabilities are higher for this to happen. I mean, obviously you can't know for sure, but I think that's a higher probability. And I've said before, I think February, March 2023, we're going to see inflation start to drop quite fast, simply because of the way it's calculated. Now, getting inflation under control doesn't mean we bring back inflation to 2%. Or job done. No, this means we baked in all this massive increase that we've seen this year. Theoretically, we should see negative inflation to bring us back to where or close to where we were before. We're not going to see that. I don't think we are. But I do think that we're going to, I think the data is going to really surprise to the downside. And I know a lot of people saying, oh, inflation is not transitory, higher prices are here to stay. Yes, they are here to stay, but the rate of change, I think, will drop. That's the thing. That's what inflation measures, the rate of change of this, basket of goods, which includes, all these things. That I think is going to fall, it could fall to zero. That's the thing. We had this huge jump early this year with the Ukraine. You have to match that that rate of change to have inflation not drop. So I think we're gonna get really surprised. So I think that this chart of peaking rates there and cutting relatively quick, it could well happen, but I just think that the market first is going to get to a point where it's going to reprice a lot higher before we see what actually turns out. Right. That's what I think, because we're so close now to the Fed next week. And I think the risk is, I said it last time with Powell, I thought the risk was for him to disappoint. He didn't. But now look at what we're pricing. We're pricing just 50 more. I mean, you do a 50 now in December. And if he's not dovish, if he just guides neutrally, one more 50 and we're there. Does it mean they do another 50 and they stop? I find it hard to see how the market is going to price that. So, you have to understand what you're expecting from the Fed when you take a view on the dollar, on equities, on metals, unless your view is, what's going to happen tomorrow or in the next 15 minutes. That's a completely different story. And so if you take a view on risk, this is what you're trading. And let's face it, the other central banks, with small exceptions, they're following what the Fed is doing, more or less. And of course, they are also affected by the same factors: inflation, unemployment, and the world is now a global place. It's not that inflation in the US going to 10% and the Eurozone is going to be at 2%. It's all one thing. So you have to be aware of what you are expecting from the markets and from the Fed and from data when you take a position. So I personally am waiting for this spike, which I think is going to come in yields. I think we're probably going to test these highs here on this descending channel. So coming in around 390 now. There's a 50 DMA there as well. So I think a hawkish Powell, or basically a non-dovish Powell, could start driving us higher. And we've gone quite far, quite fast in yields. I didn't expect this drop to these levels, but look, we're at confluence of supports. So it's all kind of coming together for a potential move higher towards 380, 390. Go on.
And that's why I was asking you earlier if you knew about any seasonals also, because also in my opinion, this latest drop, okay, we can trade recession fears, but then it's not supported by the labor report, for instance, and it's not really supported by what Powell said either. So, okay, to me, they are slowing down. So I think the peak expectation might be good, but then I think they will stay high for longer. Also because Powell said that they want to be in positive territory. So imagine that, where is inflation now still? Remind me.
10%.
How much?
10, right? 10.1. 10.
No, in the US?
Sorry, that's UK and Europe. Sorry, eight something.
Yeah.
What was it?
So imagine we're going down to 4. If Powell wants to be in positive territory, that means that Fed funds will have to stay above 4 for a while.
Yeah.
So that means that the market right now is, well, and it's a big word to say because the market is never wrong, but the market could be wrong this time in pricing what the Fed is all about. And that's where I don't understand why exactly we keep on dropping in those yields.
Yeah, I don't know.
Yeah. Okay.
But this is what we have. So so what does that mean for risk? If this turns out as I think it probably will, then we're going to see the usual, yields higher, stocks lower. And look, this was a lovely, we were talking about this range, remember, 40.50 to 4100. How many times did we talk about that when we were still here in the 3800s? And we're saying, yeah, there's good chance we're going to get there. And this is exactly where we stopped. I mean, this is technicals sometimes are absolutely fantastic. So if we do get a spike in yields towards 380, 390, then I think equities obviously are going to go lower. How much lower? It's a good question, but I think we could even retest these lows around 3,600 here. I don't see a reason why not. You know, it's as simple as that. So that's my I don't want to call it the base case, but I think that this is the most likely scenario for now, given what the market has done recently. And then we're going to see, I think, a look at the DXY. I mean, this fib is from the May lows to the September high. So this is almost a year and a half. So this is a big, this is a pretty big time period, and we've come to the 38.2, which is always a very important fib, and we're kind of there. And we have also the 200 DMA. I know we're a little bit below, but we're basically at that range, that area. So a hawkish or a non-dovish Fed next week will push the dollar higher towards 108.80, this 23.6, or even higher. So this is, for me, something that I'm watching. That's why I'm a little bit scared of adding more to my my precious metals longs. I for those who follow me on the chat room, I've been slowly accumulating in silver, and I'm waiting for this move to get in more, to maybe buy some more miners and start building the position a bit more. But I do think the odds are really skewed now for this move to happen. Obviously, it could not, right? If Powell is not hawkish, or if he's dovish next week, this all goes out the window. But I think you have to play the probabilities. It's a bit like poker. So you play the probabilities, and if you play them long enough, and if you're disciplined with your stops, then you're going to be winning overall.
And you know what? And you know what I've always kept an eye on as well. And we were talking about the S&P levels pre-COVID.
Yeah.
And if you're in Powell's seat, and you look at where the S&P still is, where's the panic level? 3,400, 3,300, and
exactly.
We are at 3,900.
Yes.
So if you're in Powell's seat, you say that, well, you know what, assets are holding up pretty well. I can continue to go, and the labor market is still tight for now, and we know it comes with a lag. But if you're in Powell's mind, you say like, oh well, hang on a minute, I can still continue to go, because we're still not back at 2019 levels even.
Exactly, and the way that the S&P and the equities have been dropping, there's no panic in it. So this is exactly what Powell wants to see. And, the Fed will get criticized for not fighting inflation, but they will not get criticized as much for having, risk equity markets dropping to, like you said, to where pre-COVID levels. I mean, what's wrong with that? There's absolutely nothing wrong. Obviously, there's been a big increase in money supply since then. So theoretically, they shouldn't really, I mean, you can't compare the two. It's a different thing that we're comparing if we get to 3,300 now compared to pre-COVID. But, this is what people look at, anyway, I agree. I think that's where the pain level is. And
don't forget, they are doing QT right now. So, and the asset markets are still holding up. The S&P is holding up. So, and even within QT, I thought when they really started to do the real QT that this market would actually take a dive, and it didn't. So okay.
Yes, indeed. So in F.A.C.E, couple of things I want to show. We talked about the pound before. For me, the euro pound is I don't trade it on a daily basis, or I don't even trade it for a week or two. I trade much more longer term. For me, it's in no man's land. So I'm going to leave that well clear. 83 to 90 is the range that I like playing. And unless something major changes in the macro picture, or the central banks, the two central banks involved, I'm going to leave it. The one I do look at all the time is dollar Norway. I don't think we're going to ever get back to these levels here. The COVID spike, that was I managed to catch a little bit of this. Obviously, I didn't get the highs, but I managed to get a nice little bit of this move lower. But I don't think we're going to get there again. not in my lifetime. Actually, no, that's a big thing to say. But I want to sell dollar Norway. So when we get this spike in, or if we get it in dollar and yields, this moves a lot. I actually don't think this trend line is going to hold, because this tends to move, 1-2% in a day. So, but if we get anywhere near 1040, which was this high here, was a low there, it's a level which it does seem to have interest. If we get anywhere near 1040, I'm going to start shorting, and I'm going to do it probably in tranches, and I'm going to probably add higher. But I love this as a trade fundamentally. And as I said before, I think the Fed will turn. I think they will turn in a big way, but I think the market first will price the opposite before they do. And I have to say it again and again, we need to brace ourselves for the inflation readings that we're going to be seeing in February, March, April 2023. They're going to be shockingly low, in my opinion. Another very interesting one, we've seen this so many times, dollar MEX. We were looking at this for a breakdown. It did break the lows, but it's come right back up. So this false breakout, false breakdown. I'm not touching this. I want to play this on the short side, but not yet. I will wait for the spike to happen, and then I will try to pick my levels. But this is one I want to play on the short side because of the positive carry as well. We talked about it for many times. Aussie, Kiwi. We saw that before. Look at this range. This has been at almost 10-year range. I mean, this is solid as a rock as a pair. If you think about the range here is what, 15% from bottom to high. It's surprisingly stable. But I will look to play this on the bullish side. I think that there is a convergence between the two central banks. So the RBA is more dovish than the RBNZ, but that won't last forever, like Cayman very correctly said. And China potentially reopening eventually, that's going to be a big positive for the Aussie. So I'm looking this to play this on the long side. Haven't decided on levels yet, but I'm just gonna watch a price action for now. But this is something I'm looking at quite closely. And then similar thing is the Aussie dollar. That I want to play to the long side, but I want to first wait for a spike low. If the dollar rallies, as I think it will, in the next few weeks, I think we're probably going to get back to the 61.8 level, mid 64s. That for me is going to be a very nice risk reward long, but I wait for that first. What else? We have to talk about cryptos. We've talked about them many times. Still consolidating in a very bearish way, any way you look at it. And trust me, if we do see the dollar spike and yield spike, as I think we will, this is going to drop below. Think about it. The sentiment is now supremely bearish on cryptos, and nobody likes them, and it's still not managing to muster any kind of relief rally, because when everybody hates something, it usually goes up. When everybody loves something, it usually goes down. I mean, that's the thing, and it's still consolidating here. It looks very bearish. And if you ask me, do I think Celsius, Solana, what else, Safe Moon, FTX, do I think we're done with those? I think everything's interconnected in this universe, I mean the crypto universe, and I think we are going to see more of these of these disaster scenarios, especially if we see another leg lower in price. We haven't talked about Michael Saylor for a while and MicroStrategy Holdings, but he has to have, they have to have a pressure point at some point where they have to sell. Yeah. If we do break below 15.8, what is it, 15 something, we're about $1,000 away from these lows. We do break those, we go to 12-13K, and I think there's a world of pain coming in for quite a few of these players who are heavily invested. So I will be very careful. If you want to be long, great, but you know where your stop is. And I'm going to repeat it one more time. Your stop being at a place doesn't mean it's going to get filled there. So, you put your stop at 15.4, you might get filled at 14.8. You never know, because of the liquidity, because of the way these things move. And
All right.
Yeah. So that's it.
Those are very wise words, and I'm looking at the clock, so we are going to close it for today. Thanks very much, Telios, for all those medium-term charts and views. Thanks to all the listeners. I hope you liked it, and we talk to each other tomorrow.
Thank you,
Have a great trading day.